oil futures options by www.options-trading-education.com. The deal to curtail Iran's nuclear ambitions will relieve sanctions on the country. Iran has the fourth largest oil reserves in the world, and Iran will soon start exporting oil again. How will oil futures options respond? According to Bloomberg Business, there will be a gradual return of Iran's supply to the market. Oil rose, reversing an earlier loss on speculation that the return of sanctioned Iranian crude will be gradual following a historic accord with world powers on the country's nuclear program. Iran's agreement to curb its nuclear program in return for the removal of sanctions is the first step on an arduous path, according to ING Bank NV. It will enable Iran to restore about 500,000 barrels a day of oil exports by mid-2016, Commerzbank AG estimates. The market reaction was exactly as we thought it was going to be, said Ed Morse, the head of commodities research at Citigroup Inc. in New York. An initial sell-off and then a rebound after that when the market realizes there is going to be no Iranian crude on the market for months. Restrictions on Iran will remain in place at least until United Nations monitors report on the country's compliance with the deal in December, diplomats involved in the talks said Tuesday. A slow return to the market could mean Iranian crude arrives just in time to satisfy growing demand, rather than inflating a surplus, according to Societe Generale SA. West Texas Intermediate crude futures are pegged at $52.81 a barrel for August delivery. If the introduction of Iranian crude to the market will not make a big difference for at least a year, what are the other factors that will drive oil futures options? Chinese oil consumption. China has the second largest economy in the world after the USA. China consumes about 10 million barrels of oil a day. However, oil consumption is linked directly to the strength of the Chinese economy, which is slowing. The Wall Street Journal says that there are few signs of revival in the Chinese economy as it cools off. China is targeting growth of about 7% for the year. A reading below that level in the second quarter would underline the government's struggle to put a floor under the country's slowdown. The median forecast by 14 economists surveyed by the Wall Street Journal was for 6.8% growth in the quarter. There are some signs that the economy has started to stabilize. Property prices in China's largest cities are rising after an extended slump. Industrial production edged up recently, and new bank loans were up significantly in June, adding capital for companies' expansion. But global demand remains weak, and broad areas of the world's second-largest economy have largely failed to respond to 4 interest rate cuts and several adjustments in reserves that banks are required to hold since late last year. The end result is that China will not be burning more oil, but probably less, as its economy sinks from the 10% per year miracle days to something more like 5% in a few years. Oil futures options will eventually reflect this fact. Exploiting new oil reserves. Due to the current low price of oil, many oil companies have cut back on exploration, drilling, and oil production. Moody's.com comments on the effects of reduced oil exploration. Plunging oil prices are moving oil companies to cut spending on exploration activity, presenting a major challenge for seismic companies globally as the most volatile and cyclical segment of the oilfield services industry, says Moody's Investors Service in a new report published today. In order to keep up with loss from oil wells that play out, oil companies need to replace between 8 and 10% of production each year with new wells. When exploration and drilling are reduced, the results are less production and higher oil prices. Oil futures options will reflect this fact. For more insights and useful information about trading options, visit www.options-trading-education.com.